Welcome to Compound Interest from Semaphore Business, a show where we explore the seismic and subtle ways that business and finance are changing. I am Semaphore's business and finance editor, Liz Hoffman, joined as always by my colleague, Rohan. Actually, welcome back. You were off last week.
I was off. I was bumped for Mark Lorien, which I was sad about, but it was a great episode.
We had a lot of fun, but we are back in more comfortable territory for you and me, which is the financialization of everything. You know, I started my career really as a reporter at a legal trade pub covering law firms. So I've always had kind of a soft spot for the business of law. Could never convince anyone it was interesting for 15 years. And now it is super interesting.
It sure is very interesting.
A bunch of reasons. You know, AI is just threatening to, I think the baby lawyer reviewing contract documents all night is just like the peak case for what people talk about when they say the knowledge economy jobs are under threat.
On a personal level, like my mother, as any good Indian mother, has never stopped ragging me about not going to law school, and just looking at and covering all the changes that are happening to 3Ls and first-year associates and the way that none of them feel like they have their feet under them. I feel slightly vindicated, if not a little bad for my friends.
That's not a comfy place to be. But, the other thing we talk a lot on the show about is sort of everything is cash flow now, and that all kinds of risks are being...
That's your favorite thing.
I am what I am. But that all kinds of risk are being like spun up and molded into to fit some, some funding hole that is sitting, inside the empires of Blackstone and Apollo and KKR and all of those firms. And so one that I've just been kind of watching for the better part of a decade now as it's risen is litigation finance. And it is exactly what it sounds like. It is a way to finance lawsuits. And one of the biggest players in that is our guest today. He's Chris Bogart, is the CEO of Burford Capital. He is a recovering lawyer, started his career at the whitest of white shoe firms at Cravath, was in-house at Time Warner, has built this business that is starting to attract a lot of attention, a lot of copycats. It is a growing kind of investment space. It is, when people say we are inventing new asset classes every day, this is what they are talking about.
Yeah, it's funny. When we were preparing for this, I was reading his exit interview from 2000 from the GC role at Time Warner, back when there were trades beyond Law 360 that covered law. And what he said was that for his next chapter, he wanted to combine law with business management. They're trying to dip their toe into everything here. They're trying to take stake. They have taken stakes in law firms. They're financing litigation around the world.
We'll get into this with Chris about there's some reasons why it's harder to do that in the U.S. But I imagine that in 10 years, Burford is a holding company for a bunch of law firms and law firm services, and is a really interesting sort of index fund of what we don't often think of as an industry because it's just like so poorly run and weird. These are private partnerships. Very few of them, it's starting to change a little bit, but very few of them have anyone whose business card says CEO. These are not businesses run all that strategically, all that commercially. And I think it'll be fun to talk to him about all that.
Well, Chris is waiting for us, so let's pause there, take a quick break, and we'll be back with more.
Every business starts with an idea, but how can you go from daydreamer to industry leader? Amazon Business accelerates your journey. With smart business buying capabilities, you can get everything you need to grow in one familiar place, from office supplies to IT essentials and maintenance tools. Amazon Business takes the buying experience you know and love from Amazon, plus tools that help you save costs and make insights-based decisions. Ready to bring your vision to life? Learn how at amazonbusiness.com.
Chris, welcome to the show.
Thanks very much. Nice to see you.
So let's start with actually just explaining for our audience, what is litigation finance and how does it work?
So litigation finance is simply treating litigation claims as financial assets. When you think about what litigation is, stepping back, it's just an effort for the most part to get money to move from one party to another. And so it's got all the characteristics of a normal financial asset. And so you can do with that financial asset the same thing that you can do with lots of other intangible financial assets like receivables. You can secure them, you can borrow against them, or in our case, you can provide non-recourse capital against them.
Okay, so this is something, if I'm a big company and I'm in some commercial dispute over some IP with one of my rivals, I've got something sitting on my balance sheet, which is maybe I'll get some money in the future. And you have turned that into an investable product, right?
In fact, yes, and the but is that it's not even sitting on your balance sheet. It's invisible to investors. because we don't put, for an operating company, we don't put a piece of litigation on the balance sheet. We usually just stick it in a footnote and say that it exists. And so you have effectively this invisible financial asset that has value that businesses are, for the most part, not capitalizing on. So there's a balance sheet component to this, but there's also a really important P&L component to this.
This is the money that general counsels are spending every quarter paying their lawyers.
That's exactly right. And when you think about that money, that's something that investors, generally speaking, are not going to reward the company for doing a good job at. And so what you have today is a world of litigation where the general counsel is taking money away from the growth of the operating business, taking money that could be invested in growth, and instead is diverting it to this collateral activity. And so what we do is come in and avoid the need for that diversion to happen.
Got it.
So where did this industry come from? What is the origin story? What is the case that sort of convinced people that this was an asset class that was worth chasing?
Well, the origin story is that companies have always been frustrated with this problem. And as you said, I was once upon a time the global general counsel of Time Warner. So Time Warner at the time, big media company, no liquidity issues, lots of capital. But that didn't change what I said earlier about the disinclination of a business to divert capital away from its movies and its music and give it to me, the lawyer, so that I could go and hire other lawyers with it to try to make some money in a collateral litigation claim.
You were a cost center.
I was a cost center, and it's even worse than that, because if I'm spending the money, that's reducing corporate profits, right? EBITDA is going down, net profits are going down. Time Warner's trading at a nice multiple. So I spend $10 million on a piece of litigation. Time Warner's trading at 20 times EBITDA. That all of a sudden is a $200 million hit to market value. The problem is when I go and spend that $10 million and win 50 with it, investors on the market are not going to give me a 20 times multiple on the 50. And so I'm actually destroying shareholder value by spending my own cash to go and get a cash positive outcome in litigation. So that's the problem that was always there. Now, when you say, okay, well, fine, that exists in lots of other places, the normal reaction then is you go to your supplier, you go to the other side of the equation, in this case, the law firm, and you say, look, your business model of charging me current cash by the hour doesn't work for me. So change your business model. But law firms can't. Law firms don't have access to external capital. As a regulatory matter, they don't access the markets. There are no public law firms in the United States. There are no private equity-owned law firms in the United States. With a footnote we can come to later.
Yeah, we're going to get into all that. I'm very excited to pick your brain on that.
But for the most part, that's not going on. And so you've got this dilemma where companies don't want to be buying legal services in the way that they're being sold, but law firms don't really have another option. And so what that did is created a fertile ground for us to come in and sit in the middle of that relationship and give both parties what they want. Pay the law firms the cash that they need to make their business model work, and at the same time provide corporates the cash solution so that they don't have to divert operating funds to collateral activities.
Was there a particular case early on in the development of litigation finance that kind of made everyone sit up straight?
I think what it actually was the financial crisis more than anything else. So I had been doing this before the financial crisis, effectively as a hobby. I was running a venture capital fund focused on tech media, but I spent a couple % of my time doing this for a friend of mine who was a partner at Latham & Watkins, one of the big law firms. But I wasn't trying to commercialize it. I was just doing it as a hobby fund. Other law firms knew I was doing that, though, and I would get requests from them to expand what I did, and I wasn't really interested in that until we got to the financial crisis. And then two things happened at the same time. One was my day job, my tech media business. Well, those valuations didn't look all that attractive anymore. And at the same time, I had law firms going nuts looking for capital because their clients were all concerned about liquidity and were really clamping down on their willingness to pay for legal spending. And so that was basically an opportunity to go and try to professionalize this idea and turn it into something that is now today a global multi-billion-dollar industry.
You talk a little bit about how you decide what's a winner and what's a loser and what you're going to put your money behind?
Sure. And we absolutely are doing that in the sense that we're engaged in, a very substantial amount of upfront underwriting, even more than a traditional investment business is, because there's not really a viable secondary market for these things. And so once we start down the road with an investment, we tend to be holding that investment until maturity. We don't get to say, oh, gee, we're going to change our mind and go in a different direction. So a lot of what we're doing, because we're not buying them and we're not controlling them, a lot of what we're doing is that upfront investing activity. And so we're looking at a large pool, just like a private equity firm does. We're looking at a large pool of inbound potential opportunities, and we're sifting through them to try to find the ones that we think have the best combination of legal merits and quantifiable, supportable damages and collectability. And those are really the three pillars that we look at when we do this.
Are there hard and fast characteristics? I mean, it seems more kind of like IPO underwriting, more like an art than a science here.
Well, I think there are two important things, three really. The first is obviously you're looking for cases that you think are going to win if they go all the way to trial. That's sort of the table stakes. But then the other two things are you're looking for real damages. So we don't do this for airy-fairy thoughts. Gee, I should have, would have thought I was going to get this great outcome, but I don't really have a good concrete proof of damages. And we're looking for collectability. We're looking to be sure that if we do go all the way through this piece of litigation and get to a positive result, that we can actually get our hands on the money, as opposed to it being, for example, hidden in some Russian oligarch.
You've seen a lot of deals break up. You've seen both sides sue each other. It's been predicated on antitrust. Do you guys work at all with, I'm thinking right now, the big case that I'm tracking is Albertsons Kroger, right? There's no downside to Kroger stock price. Is that somewhere where you would step in and say, we'll finance this for you, Albertsons? You focus on running your business. We'll sort of take this off your books. Have you done any sort of merger breakup financing?
Yeah, that's without going to specific cases, that's exactly the kind of thing that corporates come to us for all the time. Like we've worked with, I think it's 97% of the AmLaw 100. So the 100 largest law firms out there, along with the boutiques that have spun off with them. And so the cases that we're doing are the kind of cases, frankly, that you're covering. We're not a middle market business. We're not doing sort of the slip and fall, the guy in the office who's changing the light bulb who falls off the ladder. We're not doing those cases. We're doing large dollar, complex commercial litigation that costs a lot of money. And it's the fact that it costs a lot of money that motivates businesses to try to look for alternative arrangements.
Tell us the story of YPF, where this started, and then we'll get into kind of the ruling that came down against you guys a couple of weeks ago.
So YPF is Argentina's oil company. Argentina, under a different administration years ago, privatized YPF, IPO'd it on the New York Stock Exchange. To get that deal done, because Argentina already had a, shall we say, a somewhat checkered history of its reliability in the global financial market, Argentina had
occasionally falling back in love with nationalizing things.
Yeah. For those not aware, there was a iconic fight involving a New York hedge fund,
and a large warship,
a warship, and armed standoff in Africa.
Okay, so to get that IPO done, Argentina had to make a very specific promise as part of its IPO, and the promise was that if it ever gave into those nationalizing impulses, it would tender for all of the shares that it had sold in the IPO. It would take the company entirely private. And so it made that unconditional promise. And there was even a table that sets out the way that you calculate the tender price. So it was very clear. And it's also clear that without having made that promise, the IPO would never have happened. Investors simply wouldn't have bought the stock. Well, you can probably guess the rest. Fast forward to a different administration.
This was Kirchner or Milei?
It's Kirchner. YPF finds a big, new, very valuable oil field. And the Argentine government says, gee, we'd kind of like to own that ourselves. And so off they go, and they renationalize. They basically expropriate a majority of the shares of YPF. But they don't follow through with the tender offer obligation. In fact, they completely renounce it. They say it was a bear trap and that only fools would believe that they would pay so much money out. And this is a completely financial calculus, right? These are sophisticated players. They did a full analysis that's public about, what it would cost us if we had to tender today Or what if we litigate instead? What's the time value of money basically associated with that? And an important part of that is the interest rate arbitrage, because Argentina was paying, of course, way, way into the double digits in terms of cost of debt, whereas the courts are only going to award single-digit interest rates. So Argentina says, no, we're not going to pay. The result of that is that the second largest holder of YPF shares, the largest holder was Repsol, that's the shares that were expropriated. The second largest was this Spanish firm that went bankrupt because it had borrowed against the shares from a consortium of international banks. And so we were ultimately appointed by the Spanish bankruptcy court to provide capital and some management expertise as those shareholders went and pursued a U.S. federal court action to enforce the tender offer obligations. So after the usual litigation delays and tactics and so on, you get all the way to the end of the road, and the former chief judge of the Southern District of New York, which is the Manhattan trial court that has jurisdiction over New York Stock Exchange matters, goes through a fairly straightforward analysis and says, yes, there was a promise, it was breached. Here's the formula for calculating the damages. They should have made the tender offer, they didn't, and here you go. And so a couple of years ago, entered judgment in favor of the plaintiffs. So that was where we were until a month ago.
For $16 billion, right? For a lot of money.
Yeah, for $16 billion. But the reason that number is so high, again, is because of the interest dynamic. So the tender offer formula gave a number of something like $8 billion of damages. It's consistent with the share percentage that these shareholders owned of the company. But then the fact that Argentina, is a very dilatory litigant. So the litigation has been running since 2015. So 11 years in, the interest component, even at the lower U.S. court rates, the interest component is another, by then, $8 billion.
So you had this big win, and then you didn't. So you got the Second Circuit ruled against you a couple weeks ago. Explain their argument. And my understanding is that you do not think this is the end of the road.
Yeah, it's not the end of the road in two ways, and we'll come on to that. But first, what did the Second Circuit do? So the Second Circuit, a three-judge panel of the Second Circuit, which is the federal appellate court that sits above the Southern District of New York. And so it also basically supervises securities actions, New York Stock Exchange. And historically, this has been a court that has been very attentive to the posture of the U.S. capital markets. And so it has been sort of a pro-market, pro-shareholder court in terms of enforcing shareholder obligations like that. Unfortunately, what happened here is that this particular panel and the judge who wrote the opinion, and it was a divided panel. There was a dissent. So two judges voted to overturn the judgment. One judge would have upheld the judgment. The judge who wrote the opinion was clearly affected by issues outside just the question of enforcing this capital markets promise. His opinion, the very first sentence of his opinion opens with a commentary on how much this was going to cost Argentina, sort of ignoring the fact that Argentina has already made a lot of money out of this defalcation. So on that,
because they've been producing oil from that field this whole time.
Exactly, and they've been having the benefit of owning these shares. So with that as a starting point, once you start reading that this is probably not going to end well. And basically, the bottom line was he declined to enforce the promise. He said that, and the language is pretty striking. He calls it a knowing and flagrant violation of the promises it made. If a government wants to put a highway through my house, doesn't matter that I might not want that. The government's free to come in and take my house as long as they pay me compensation for it. So Argentina and Repsol did what Argentina and Repsol were supposed to do. The problem here was that Argentina didn't do for the rest of the shareholders what it had promised to do. And of course, the share price collapsed when this all happened. So, the court said it's a knowing and flagrant violation of the promises it made. It acknowledged that everybody agrees. Argentina agrees that it breached the promise. That's not a disputed fact here. There are no facts in dispute in this case. And the court even went on and acknowledged that the IPO would never have occurred if these promises hadn't been made.
Do you think there was pressure, either indirectly or directly, from the White House, which is obviously very close to the Malay government?
I don't. I don't think that at all. I think the courts, notwithstanding the turbulence of our politics, I think that the courts have remained an independent branch of government. So no, I don't think that there's any dynamic here where you've got, people in the White House picking up the phone and talking to the Second Circuit judges. But I do think that we have injected a lot of social policy and politics, frankly, into judicial decision making. And I don't think these other considerations really have a place here. It's very important for the U.S. capital markets to have reliance on the security promises being made. Nobody debates that this promise was made. Nobody debates that it was intended to be enforced. And now we've got the principal court overseeing the New York Stock Exchange basically saying, no, I'm not going to enforce the promise. I'm going to instead worry more about a larger social policy goal.
What is next for you? Do you take this to the Supreme Court? How are you thinking about that?
Yeah, so you'll do two things at the same time. One is you'll continue to seek review in the U.S. courts. And so that means first you'll try to ask for the entire Second Circuit instead of just a 3-judge panel to rehear the case. That, though, as a practical matter, happens very, very, very rarely. And so it's unlikely that will happen. And then you can ask the Supreme Court to review it. And again, statistically, your odds of that going well are poor. But we'll give it a try and see what happens. The other thing, of course, is that what the Second Circuit basically did is it set this case up for investment arbitration. So there's this whole separate world out there of bilateral investment treaties between countries. There is certainly a treaty between the United States and Argentina. There's a treaty between Spain and Argentina. And those treaties allow damaged investors to bring arbitration claims outside of the national courts. And so here, that claim will probably be brought before the World Bank, before something called the International Center for the Settlement of Investment Disputes. Argentina is a regular defendant in those cases. Dozens and dozens of cases over the last couple of decades. We've actually litigated and successfully against Argentina in that forum before. The problem is that's a multi-year process. And so, it's very disappointing to see the U.S. courts not sort of stepping up to the plate and protecting the U.S. capital markets.
What are you telling your investors?
Yeah, I don't think that there was more risk than we thought. I think what happens, though, when you have a very large judgment like this is, if you go back and look at our stock over time, you'll see that our stock went way up when we won the judgment against Argentina. And so now it's gone back to basically where it was before there was any Argentina judgment.
The last really big Argentina case in the Second Circuit in this vein was Paul Singer's case. This is the Argentina case that we were alluding to. This was the NML Capital case, and that was about 13 years ago. And there, the Second Circuit did affirm Elliott's rights, and that went up all the way to the Supreme Court, which declined to overturn the Second Circuit. Something does kind of seem to have changed just on the face of it in the last 12 years.
Well, it's certainly anxiety provoking. The Second Circuit did in fact uphold Elliott's goal here. And Elliott, remember, was engaged in something considerably more aggressive than we were.
Yes. They were literally charting out a new shape of law in real time.
Well, they were, but they were doing it as the owner of the underlying asset, right? So what Elliott did is Elliott bought these defaulted bonds at a low price and then litigated to try to get a higher price for them. We're not doing that at all. We don't own this asset. We're just providing the capital at the request of a bankruptcy court. And sure, we stand to gain a contingency style fee if we're successful, because look, we've put $100 million into this over the last decade and we've spent 11 years doing this. And that's by the way, the reason that you need people like us. Because if you don't have somebody with a large diversified portfolio in the way that we do, you're never going to be able to bring a case like that. This bankruptcy estate could never have summoned up $100 million and sort of 11 years of litigation management expertise. So it was very surprising to us to get that result, because it does, as you said, Rohan, create a deviation from my perspective from the path that I would have thought the Second Circuit should be staying on.
There's an obvious inefficiency here, to your point. You, as a publicly traded company, you can't be a law firm. You can't in-house this. You can't extract the kind of cost savings that you would be able to if these were the attorneys that you employed. First of all, for our audience that doesn't quite understand why law firms can't be publicly traded as the law stands right now, can you walk them through that for us, just why that's impossible as it stands right now?
Sure. So in the U.S., and this is a country by country, and as to the U.S., it is a state by state issue. But in the U.S., 49 of the 50 states don't allow law firms to share their revenue with non-lawyers. So the only thing you can do as a law firm is have the partnership sharing in the profits that the firm is creating. And that not only prevents external capital, whether it's public market investors or private equity funds, from investing in law firms, it also, by the way, deprives partners in law firms from getting exit value for the equity value that they're creating. They have no way of monetizing that value that they've created over time. And that is simply the set of rules in the US, and there is not an enormous groundswell of effort to change them. Arizona is an exception to this. Arizona saw a market opportunity and opened the doors to non-lawyer ownership of law firms. But Arizona, with all due respect to Phoenix,
no one's going to give up their New York office for a Scottsdale
not
office.
Exactly. Until you can have that happen in a more national way, it's not going to fundamentally change the world. Now, there's an interesting question about whether this will happen if you allow it to anyway, because you look across the pond, England has allowed non-lawyer ownership in law firms for 20 years now. And you've had a lot of activity. There are about 1,000 law firms in the UK that are owned by people other than lawyers, but they are not magic circle firms. So people are doing interesting things at the consumer level, at the real estate level. So now you can go to a law firm that does it all for you when you buy a house. So that's fine, that's great, but that's not the business that I'm in. But Freshfields is not yet attempting to go public any more than Cravath.
Investment banks said this in the 1980s. They sort of had they were private partnerships, and they had their code of ethics, and they would never, and the commercial interests and all of that. But the commercial pull of just getting fabulously wealthy, taking your law firm public. Why isn't there more of a groundswell?
Look, I think one of the principal barriers to this happening is that doing this individually is scary. Because if you are the only law firm that goes and tries to do this, there's a risk that you're going to be at a competitive disadvantage. Because fine, you go and sell 20% of yourself to a private investor like me. Well, now you're playing with 80-cent dollars while your competitor down the road is still playing with 100-cent dollars for partner compensation. So it kind of needs to all happen at once. And that's exactly what happened with the investment banks, right? You click your fingers, and all of a sudden we had private partnerships moving to public. And it wasn't just one of them. It was a whole group of them. It makes you wonder if there was a dinner one night.
The Last Supper of investment banking.
Fantastic for the great one.
Let's take another quick break. We'll be back with more from Chris after this.
Welcome to What's Working, the show within a show featuring compound interest seasoned partner Amazon Business. I'm your host, Rachel Oppenheim, joined by Amazon Business VP of Technology, Doug Gray. Welcome back, Doug.
Thanks, Rachel.
Amazon, to me, is known as being one of the most customer-obsessed companies on the planet. Are there any specific customer stories that are just exceptional that you'd be open to sharing here today?
Thanks, Rachel. Hearing from our customers about their real-world stories really inspires us to keep innovating. So, picture Kodiak Island. It's an island 250 miles south of Anchorage. It's reachable only by plane or ferry. Now, imagine the challenges of operating a hotel there year-round in a place so remote. They have very few local vendors, unpredictable delivery schedules, and it's Alaska, so weather shifts overnight. Even simple items like light bulbs or cleaning supplies take days to arrive. So they now rely on Amazon Business's tracking and reorder tools to anticipate their needs weeks in advance. Amazon Business integrated into their process, providing the products they needed, from guest amenities and cleaning supplies to operational essentials, all at low prices and with delivery they can count on. Predictable deliveries and real-time tracking have helped Best Western staff keep critical departments running without interruption. For them, The ability to operate with consistency and calm is transformative because it allows them to focus on what really matters, their customers.
You went as an investment banker from being a lifer at a firm and, cradle to grave there to, a degree of mobility that has continued for the last 30 years at the very top of investment banking, something which law historically had been immune to, but now is not. And every day it feels like we read stories of these fantastic pay packages. Is the fear that you won't be able to compensate, rainmakers with 80-cent dollars as opposed to 100-cent dollars part of why you think there's sort of maybe a hesitancy?
I do think it's a collective action problem, though, because when I talk to managing partners of law firms, it used to be, as to your point, lawyers didn't move around very much, and there wasn't a lot of technology in law. And so you didn't really need capital to begin with, right? You weren't really investing in very much stuff. Like when I was a young lawyer, what did that mean? I had an office and a laptop, that was it. Today, law firms need to invest in two things. Number one, Rohan, to your point, they need to invest in people. They need to be giving those enormous guarantees to the partner that, that Kirkland today lured from Paul Weiss, and that tomorrow Paul Weiss is going to lure back from Kirkland. And number two, law is not surprisingly an industry that is on the early edge of being significantly disrupted by AI. Large language models are large language models. Law is a large language. And so law firms need to be investing in technology in a way that they have not historically had to do. And so they need those two sources of capital. And right now, the only way for them to pay for that capital is to cut their partner compensation, right? Or to borrow from a bank, which partners are personally on the hook for. So those are not great options. And so it's logical for them to want to do this, which is why, we get calls from just about every managing partner out there talking to us about what's going on in the market, but everybody is sort of waiting for somebody else to try to take the next step. And we also do need some regulatory relief.
Seems like you're in a great position to actually put that dinner together yourself and book out a private room and surprise all these guys. Surprise, you're all here now. Let's get down to basics here.
The other thing you can do, if there was a real desire to do this, is, without wanting to go too deeply into the weeds on this stuff, there's a plan B if you really were keen to do this, which is an MSO structure.
Walk us through what that is.
Yeah. So when you think about law firms, like the prohibition that we're talking about here, the regulatory, the ethical prohibition, is as to the provision of legal services. Law firms do lots of things that are beyond the core provision of legal advice. Right? If you're going to trial, what's a law firm doing? Well, yes, there are lawyers going to trial and standing up in court and making arguments, and that's a legal activity. But they're also renting hotel space and hiring court reporters and bringing in expert witnesses and doing all sorts of things that they make profit on and that they charge their clients for, that are not technically legal services. And so what you can do is you can separate those two things. And you can say, okay, fine, we're just going to have the law firm do the legal services. And then over here, we're going to have a non-law firm structure that provides all the services to the law firm. And that non-legal structure, the managed services organization, the MSO, that can be owned by third parties. It's not uncomplicated to set that up, but it's not impossible either. And so if you're a law firm that really wants to do this, and you either don't think you can or you don't want to wait for the regulatory relief, that's the road by which you would travel.
And the MSO is where you take the outside money, or you take that thing public and it becomes... Is that like a one-to-one where Skadden would have its own and Wachtell would have its own, or is there like an industry utility that could get a bunch of these non-legal fees and then go public with that business model?
I think it depends a little bit on size and inclination. There's no reason that you couldn't have commingled ones, but my guess is that a Wachtell is not going to commingle an MSO with Skadden.
But is that something you'd be interested in financing? Is that
absolutely. So when you look at what we do in the UK, we have an equity stake in a law firm in the UK. We have an equity stake in another firm called Kindleworth that stands up smaller law firms. So if you are today a litigation partner at a big firm and you're frustrated with the conflicts or something and you want to go out on your own, That's actually kind of hard to do, and lawyers don't have any business experience about doing things like that. So you'll go to these guys at Kindleworth, and they'll stand you up instead. And they've stood up lots of boutiques that have gone on to be significantly successful law firms. So yeah, and we'll provide the financing for that. So yes, we're active in all of those places and happy to do it, and we'd be happy to do it in the U.S. as well.
Isn't part of the problem there, right, that this is kind of the MSO part of the business, right, the document review or the services is exactly the part of law that is going to demolish the business model of a Latham and Watkins. AI will suddenly, not suddenly, but over time will do this, and law firms just won't be able to charge for it anymore because anyone can do this, and it'll really go back to being like a very boutique-y, very sole practitioner model.
Look, I think it's certainly a risk. Thus far, you've seen a world where that risk has not showed itself in economic reality. The numbers are just out a couple of weeks ago for 2025's law firm numbers. The top 25 firms still are posting another year of double-digit profit growth, another year of double-digit revenue growth. So you're not seeing it in the numbers
yet,
and you're not seeing it in the behavior yet of either clients or the senior lawyers at law firms. In fact, just this morning in the American Lawyer, there was an article about how AI is making senior lawyers enabling them to charge yet more. What I think is the greater challenge is as you go down the market. Right, the stuff that when the next time you need a will written, a house closed, a trust drafted, and I think there's a genuine question about what you do to become a really good senior lawyer. If today all of the things that you do as a junior lawyer can be done just as efficiently by an LLM.
Do you talk to a lot of general counsels though? Do you get the sense that they're going to start looking at their bills and saying, why am I being billed for a $1,500 associate hour?
Yeah, I think they've been doing that for years, though. And the problem remains that today, if you're a director of a Fortune 500 company that's about to do a capital raising or an M&A transaction, you want fill in the blank of the favorite law firm that you like, but you want the brand name of that law firm associated with your deal. And that's why you have seen the tolerance for these rates, which are counterintuitive, right? Why are law firm rates going up faster than corporate profits? Like, it doesn't make any sense. But the reality is there's brand power that people are willing to pay for. And that's why you've seen this continued widening between the top of the funnel, the top 50 firms in the country, and the pressure that is on, the 500th firm.
Okay, let me try a theory on for you, which is I don't think that AI is going to kill the law firm, but I do think it might kill the billable hour. Like if you are, so I think famously Wachtell sends these for services rendered with a large number, and who quite knows how they got there, but they bill like investment banks. And
they get paid.
Curious, and they get paid, and their success fees, which exist other places. Do you think that that's what the future of law firm economics looks like? We do a lot of work for you. It went great. Here is a very large number. Please send us the money.
I think it depends a lot on the kind of thing that you're talking about. So when you look at Wachtell does that when they do, successful M&A advice. But Wachtell also does what investment banks do, which is not send that big bill when the deal craters. When you are dealing with other kinds of legal services, it's much less common to have that dynamic. It's much less common to say, okay, well, yes, we did this piece of litigation for you, it took 10 years. The general MO, the general modus operandi there is the billable hour. I hate the billable hour. I've been campaigning against it since 1998. When I was general counsel at Time Warner, we did the AOL transaction, and I insisted doing that transaction on a non-billable hour basis. I actually did it on a contingency fee basis.
Wait, how did you set that up? I'm curious. This is going to be the second thing that, that deal is famous for other reasons, but we're going to make it famous for this.
I went to the law firm that was representing Time Warner. It was Cravath, and I said, let's do a deal. And by the way, this is in the days of purchase accounting. And so it was very much in my interest. If the deal closed, even paying a big fee would disappear in the mists of purchase accounting. Whereas if the deal didn't close, then the entirety of what I was going to pay in legal fees was going to hit my P&L and destroy my budget. And so I basically went to Cravath and said, all right, I'll pay you a big premium if the deal closes because purchase accounting. And if it doesn't close, you're on risk and you'll write the time off. and they did that deal.
How big a check did you ultimately write them?
I think at the time, and these sound like small numbers today, but they were big numbers at the time. I think it was $40 or $50 million. So it was investment banking
big even
style.
Yeah.
It's possible that Cravath came out the best of anyone in the AOL Time Warner deal.
I was going to say,
Everyone wanted legal services to be sold on a basis that values, efficiency and value creation as opposed to the passage of time. And so, you can go back 30 years and find me railing about this stuff. And here we are today, the billable hour still reigns supreme.
Do you think law firms are going to start sending bills that have how many AI tokens they used on it? Is that going to be a new economic unit?
Well, only to Rohan's point, once they stop being able to bill for the associate.
Right.
But I think their preference will clearly be to continue to bill for the associate using the AI tokens.
Can I have you lay out 10 years in the future, what does the business of law look like? Are there fewer law firms? Are they bigger? Are they more commoditized? Are they just a bunch of senior partners out drumming up business? Is there, to your point, a thriving, you think about the investment banks change their business model and there's a whole capital markets machine behind them. What does the business of law look like in 10 years?
I think you're right. I think that, but I would differentiate actually between corporate and securities work and litigation work. And here, once again, we're just talking about the big law firms. And the reason I say that is I think that the corporate and securities work will continue to see consolidation. I think you'll continue to see a smaller number of law firms that are very large, that are managed as professional businesses, and that continue to have, the sort of the Kirkland, Paul Weiss, Latham style dynamics associated with them. I think that's the direction of travel. However, for so long as there is really sort of any ethical dynamic to the practice of law, which certainly gets chipped away at every year, client conflicts in that dynamic get worse and worse and worse for litigators. And so what I think you'll see as well is a world, and you already see this trend of the increasing, move of really good litigators to boutiques. And I think you'll see that trend continuing as well, because, if the number of conflicts that you have at some of these law firms is so large that you're turning away so much of the business that you would otherwise do as a litigator. And so I also think that you'll see litigation moving more and more and more as just a service function in the big law firms. And the people that, for that bet the company case are going to come from somewhere else, are going to come from the boutiques and from litigation specialists.
Interesting.
And, Quinn Emanuel is the poster child of that.
Totally. And I've actually always thought that John is sort of the poster child for someone who might test the going public theory that we were talking about before, super interesting business case, owns a lot of the firm. But the big breakaway we saw last year was the litigation group that came out of Paul Weiss after the big White House fight, and I think Karen Dunn and that group. It'll be really interesting to watch kind of what they get up to, unshackled from whatever that was.
Exactly. But to your point about John Quinn, for those of you who don't know that, John Quinn started Quinn Emanuel literally from scratch. I've known him forever. I was one of his first clients, and has grown that firm to clearly something that on any valuation metric is a multi-billion-dollar business. And today, after spending 30 years creating that equity value, everywhere else you go in the market, you could, as you walk out the door, participate in the creation of that equity value. And today, John can't, right? And that's, I think, the motivation for so many partners who look back on their careers and say, look at all the value I've created. If I'd started a technology company, hell, I'd be rolling in money. And today I'm leaving it to the next generation as a charitable act. I'm
seeing him in Milk, and I will ask him for the 30th time what he plans to do. And I suspect for the 30th time, he will not answer my question.
We've talked a lot about what AI has or will do to law firms. What has it done to your business?
Yeah, technology has been great for us. And look, I'm a technologist at heart, and so I've been investing in advanced technology in this business for the last decade. So it's not just AI as we talked about it today, but it makes our investment decisions better. It makes our process more efficient, and it also lets us engage with information in a way that we wouldn't be able to manually. Let me give you just one example of that. There are today, hundreds of thousands of federal court cases and millions of state court cases filed every year in this country. The number is something like 12.5 million if you add all of those together. we would, and most of those cases don't have a specified dollar value in them. They just say, oh, for the damages that'll be proved at trial or something. We would like, as a business development matter, to be able to identify in that pool the cases that meet our kind of financing criteria.
Based on past outcomes of analogous cases, sort of put together like a back of the envelope.
Or based simply on size and type. Based simply on give me every case that I think is going to be worth more than $100 million. We have had no ability manually to do that, right? It's such a large pool. You can't possibly wade through the filings, even if you could get your hands on them. So we have built our own AI tool that reads those newly filed complaints and tries to assess what their value is likely to be so that we can winnow that pool down to a manageable pool to actually approach.
Has that actually filled your pipeline? Like, have you financed a case based off of that tool since you've launched it?
Well, what we use that for is a different kind of business development, because once you've actually filed the case already, you've probably already figured out how you're going to pay for it. But it's a lot easier for us to have the conversation with the general counsel that says, hey, we know you're going down the road on this case. You could have done such and so, and plant the seed for the future. It's an easier conversation than us just picking up the phone and saying, hey, let me talk to you about the wonderful world of litigation finance.
You obviously have your own funding, you're a public company, you've raised money that way. But you and I, we've talked a lot on this show about sort of everything is now an asset class, and every cash flow is going to be securitized and end up somewhere inside Apollo's insurance business or whatever. Like when you think about, and as you said, you've created an asset out of essentially nothing here, kind of like what the appetite is, where you think the growth is, how big is this industry? Is it in fact happening, somewhere inside Apollo's insurance business ultimately?
Or already?
Yeah, or already. I think it's big because this is a lot of money. Like if you think about the size of the legal market, law firms bill about $1 trillion a year globally. Now, not all of that is in litigation. Not all of that is in the kind of litigation that I would finance. I'm not suggesting that's my addressable market, but that just gives you a sense of the scale of the legal industry. And that doesn't include the underlying value of the assets. That doesn't include the litigation value. That's just the legal fees. So there are huge amounts of money here. And just as it didn't make very good sense for lots of businesses to be buying their own capital equipment on their own balance sheet, and once leasing came along, it made a lot of sense for lots of businesses to lease their capital equipment. The same argument applies here. It makes lots of sense for lots of businesses not to divert their own growth capital to litigation. It makes a lot more sense for them to use our capital. And so, I went out on a stage 6 months ago and predicted that we were going to double the size of our business in 5 years. And I still believe that.
You're talking mostly about litigation, but we talked earlier about how you structured that Time Warner deal. If a big company were doing that today and Cravath said, yeah, we'll take it, but actually we want to sell this claim at 85 cents on the dollar, is that a business that you're like, are there more opportunities kind of outside of litigation?
Yeah, we have
securitize M&A fees, basically, is what I'm asking. These are my two great loves.
Yeah, we have done things like that outside of litigation. So we've done a world where we can look at the idea of effectively insuring broken deal discounts and so on. And I think those exist. I think they are smaller addressable markets than sort of the core litigation function, because litigation is both so expensive and so long term. And so even if you've got like a terrific case as a company, you're signing up for 5 years or more of negative P&L impact before you get a positive below the line cash event. Like that's just a bad combination for an operating business.
As we make it easier to finance anything, we get a lot more of that thing. And I think your critics would say, are we building a world where we are incentivizing litigation that doesn't otherwise need to be there? How do you think about that?
Chubb, notably, was very aggressive.
Chubb is pretty mad about this.
Insurers
are pretty mad about this.
Pretty mad at you about this for a while.
I think you have to separate what we do, which is large dollar complex litigation, and the whole American world of consumer tort injury litigation. which we don't do at all. The world that we're in, I think it's completely unfounded. Like the presence or the absence of our capital is not going to determine whether a company is going to bring a $100+ million claim for damages. It's just not. The question is the most efficient financial way for the company to do that. But there's no company out there that is saying, oh, well, if Burford gives me the money, then I'll sue for $500 million. And if they don't, well, then I just won't. I'll just forget that and move on. So I don't think it's an issue with the world that we're in. I do think that the United States has a litigation problem when it comes to consumer tort style actions. I think that creates, a cost for businesses that is higher than it should be. But I don't think litigation funding adds to that problem, because we already have such a robust contingency system for those kinds of claims, because they're simply not that expensive. And so you can hang out a shingle as a lawyer and you can make the economics work with a pool of auto claims. You don't need external financing to make that happen. But I think that has called out for a long time for various levels of structural reform, and they're still missing.
And now we're back to the trial lawyers and their political donations. The fact of life.
Well, political donations, and also the fact that we've made a conscious choice as a society not to have government engage in those things. I'm Canadian originally, grew up in Canada. Like, you don't see the same kind of litigation in Canada as you do in the US, because there are lots of things that a government health system is taking care of, where here you need private compensation for. So it's not just the trial lawyers, it's a whole construct of how you want society to operate.
I always assumed it was just Canadians were just nicer, but that's a structural point. Well, listen, this was a lot of fun. Is there anything that we didn't cover that's been on your mind?
I think that was pretty darn thorough. But you've got this new podcast talking about financialization, and I think this is a pretty interesting example of exactly what you say is going on, because 20 years ago, none of this was happening.
No, and you talk to the people at the alternative asset managers, and they just cannot find enough assets, right? They have these liability machines, and they say, God, we need a cash flow that fits this hole. And actually the thing we didn't talk about that we can listen as we do our debrief is that the one nice thing they like is that this has historically anyway been uncorrelated with other things. So it is this particularly juicy piece of risk that fits nicely in. But cool. Well then, listen, Chris, this was a lot of fun. Thank you so much for coming.
Thank you very much for the conversation.
Ever wish purchasing at work was a bit simpler? The Amazon Business Smart Business Buying Podcast keeps you in the loop with the latest trends, tools, and insights for smarter purchasing. Whether you're new to buying for work or a procurement pro looking to stay ahead, we've got tips to help you make better buying decisions. Follow the Amazon Business Smart Business Buying Podcast today.
I'm surprised it took you so long to have Chris on the podcast, because this is the perfect confluence of all your favorite things: law, M&A, and the financialization of the entire world. I know you know Chris really well. What'd you make of what he had to say today?
Yeah, look, he's an evangelist for a new investment class, and Burford is, I think, the biggest fish in it. They have some growing competition. But I think, litigation finance is still sort of in its early days and will continue to grow, because, as he says, it's solving a real problem for, corporate general counsel.
Yeah.
But, I think his comments, he's obviously just spent a lot of time thinking about what the future of the business of law looks like. And he's, for the moment, is sort of being a financial player in it, but obviously has some ambitions to be a principal too.
But he's also in that weird position where right now he is hurt by the direction that rate cards are going in, right? He doesn't have an in-house staff of attorneys litigating this for him. But he also stands, if there are MSO structures in the U.S., to be a beneficiary. He's really sort of lawful neutral in all of this, and seemed pretty clear-headed in saying what
lawful neutral in the matrix. Yeah. No, I think he's probably helped by rate cards going up, because again, these are costs to companies who are trying to figure out how to do it.
To a degree, but then you have a YPF, right, where there is a possibility that you will just have to eat that cost, and it will be $100 million or $110 million on your books that you don't get back.
I think just at the 10,000 foot level, this is a business model that just would be totally recognizable if you dropped a lawyer from 1960 into a law firm today. Yeah, like they're making more money and there's some computers, but this business model hasn't changed. And that's like unbelievably unique. I mean, you just can't think of something that is as lucrative as Chris says. I mean, the profits on these law firms, these are huge businesses. And, you know, it's funny, some of them now have actually someone with a CEO title, but when I was covering law firms even 10, 15 years ago, there was a managing partner, but no one was really like running these things like businesses.
There was no business guy. Yes, exactly.
No, and you started, you know, the really good business development, the really good charismatic partners were also kind of doing the work and getting the business, and it just like no one was running these things like great companies. And I think that has started to change a little. You've seen a lot of mergers because law firms have had to sort of out of weakness merge, and that requires like someone to be in charge of actually running the company.
Yeah, the integration guy or girl usually becomes the leader of the ship there.
Yeah, but I really think that this entire industry is on the precipice of like unrecognizable change, and I don't think they're going to let an ABA rule or whatever Arizona is doing stand in the way. That will get fixed, and I fully expect there to be a fight, you know, in New York and Texas and California, states without, you know, if you don't have an office there, you cannot compete. I think that we're going to see that in a serious way in the next year or two.
And you and I have talked really more than I would have ever thought two human beings could ever talk of this, about like the collapse of the leverage model. And he did kind of acknowledge that like the MSO is a business model under threat. I wish we'd had more time to push him on this.
No, the MSO is the good business in it. It is the business that can take outside capital, right?
Yeah, it is the good business in that it's an investable business. But I still think like, what is the first thing that the Harveys or the AI companies of the world that are focused on law will disrupt and make unbillable, or will force, to your point, to your half joke, force law firms to bill as tokens? It'll be document review. It'll be processes. It'll be so much of the redlining that right now anywhere from a first to a seventh year associate can charge for, and charge a lot for, but which you won't be able to do because, to Chris's point, law is a large language. There's a lot of what law does that can be automated. Again, not the finer points of M&A, not the finesse of a litigator, but the lion's share of how Latham makes its money, of how K&E makes its money, of how Paul Weiss to a degree makes his money, is from these rote, repeated tasks where you have 15 associates on there. And there the MSO is disruptible and is like not a long-term solution for these guys taking money.
The other force that I think is pushing in this direction is that private equity firms, big asset managers, have become the largest clients of these law firms. And so the lawyers that I spend time talking to, they hang out with their clients and they're like, oh wait, I get it. Like there's a real, it has pushed this, it has made lawyers themselves a lot more commercial animals. And I think they're just going to realize that they are, for the moment, at the high end being paid really well, but sort of that their business is not profit maxing, as they say.
Okay, well let's avoid the maxing here. There was a wave in like the 2010s and the early 2020s of private equity firms, KKR and CVC and others, buying up stakes or wholesale buying PR shops. Which you and I have also talked about, never really made sense because these are people businesses and are lumpy and dangerous and risky that way. And what do you make of that risk if PE wants to get involved in law, where you do have a couple superstar lawyers that we all know at every shop that drive a huge portion of revenue for the M&A groups, the litigation groups? That seems like a pretty big key man risk for a public company. Look at what happened with FTI and John Orzag when he left. Or for a private equity investment.
I mean, one thing private equity is very good at when they buy a company is figuring out who is good and locking them in. So actually, I think that would probably be a problem that solves itself in a way that is generational wealth inducing.
But they're already that's the thing, is they're already getting generational wealth. I saw someone is getting 100 million or 80 million over 3 years. That is generational wealth. That is absolutely generational wealth, even after
for sure. But John Quinn, owns a majority, I believe, of Quinn Emanuel, and he has billions of dollars, as Chris was saying, of paper wealth that he doesn't quite know what to do with. Or maybe he does know what to do with, and that'll be our
and you will ask him when you're at Milken, and he will tell you for the 31st time that'll be the charm.
Yeah, I think that's the key. But no, I mean, this is just like a business model that has not changed, and I think we're living in a world where that's not going to continue to be true all that much longer.
Yeah, I mean, look, you and I have talked at length about like getting a really great law firm CEO or lawyer to come on and talk about the changes that are coming to the law firm model. And I'm actually really thrilled that Chris was the answer to that, like a lawyer but not doing the law, like very much thinking about it.
He's a lawyer who knows how to talk about money. That
Yes.
is, in fact, the difference. Yeah.
Yes, but I thought he was just wonderful.
And I like that he shares my my long-term eulogy for the billable hour, at least in certain contexts. I remember my dad was a lawyer, and I remember growing up and going to his office and he had a little red book on his desk. And back then they billed, I think then in 15-minute increments. And now I'm reliably told it's down to 6 minutes. And like, what a deranged way to live your life.
Insane. Much has changed, much more change to come. Well, that's it for us this week. Thanks for listening to Compound Interest from Semaphore Business. Our show is produced by the wonderful Josh Billinson.
With special thanks to Anna Pizzino, Catherine Bilgore, Claire Einstein, Rachel Oppenheim, Tori Kaur, Valana Wang, Garrett Wiley, Stephanie Chang, and Daniel Haft. Our engineer is Bob Mallory, and our theme music is by Steve Bone.
You crushed that. If you like Compound Interest, please follow us wherever you get your podcasts, and don't forget to review us.
And if you want more, you can always sign up to get Semaphore Business in your inbox.
That was insane. You just ran through that. Like, that was crazy.